With the US economy currently in a recession, investors are anxious to see what will happen to the economy in the near future. Inflation is at its all-time high and there's a lot of speculation in the market. So the million-dollar question for investors like you and I is, what is the best investment in the current economic climate? Cathie Wood, the founder of ARK Invest, has lost a substantial amount of money on her investments, but she believes that over the next 5 years, she will get a tenfold return on her investments. We've covered Cathie Wood in our previous videos, so stick around as she gives her insights on the best investments right now. Thanks for all your support. Let's get right into the video. The ARK Fund, which is Cathie Wood's main investment vehicle, has had a terrible decline over the past year. Cathie Wood is forecasting the complete destabilization of the financial system in the United States, and she is trying to make a connection between the present economic troubles and the financial catastrophe that occurred in 2008. However, she is also investing in the most inflated stocks in the world. During the past year, ARK Innovation Fund investors have lost roughly 65% of their investment capital, with some of the fund's top holdings falling by as much as 90%. You might be astonished to learn that Cathie Wood formerly had a $2 billion investment in Teladoc shares, but as of right now, that $2 billion is only worth $36 million, representing a decrease of over 92%. This means that Cathie Wood has lost over $1.84 billion in this investment alone. The most important question that arises at this point is why she is purchasing shares that are overpriced while forecasting that the entire financial system will fail. Cathie Wood's strategy is dissected in great detail in this video, in which we learn exactly what that strategy entails and how she intends to profit from the impending economic disaster she forecasts. Cathie has made some bold forecasts for the coming months and discussed strategies for enduring the recession in one of her latest videos. I think it's safe to assume that her theory will come as a shock to just about anybody who reads it. To put it another way, it is a genuine and thorough viewpoint from someone who frequently loses. A recent study claims that the United States is currently experiencing a recession, and that market conditions are uncertain. If you take a peek at the employment stats, you'll notice that they're looking really good. Every 2 months, it seems as though stocks are on the rise, and many CEOs just announce record-breaking earnings. On the other hand, there's a possibility that a number of unsettling events and developments will take place. For instance, in terms of geopolitics, the world is in an unstable state. The oil and gas industries are experiencing upheaval. As winters draw near, there are also reports of industrial unrest across Europe. Additionally, it would appear that the bubble in the eastern real estate market has burst. The United States of America is experiencing unprecedentedly high inflation, which is driving interest rates higher at a rate that has not been witnessed since the beginning of the 1980s. As a result of all that, with so many unknowable hazards, markets collapsed by almost 30% and are down by 20% at the present time. At the moment, everyone is trying to look ahead and anticipate what will happen next. Will the collapse soon happen? Or have the markets fallen too deep? Following the recent precipitous decline, the majority of bear markets have remained stable. Consequently, it gave the impression to investors that everything was operating normally and that the economy was on a path to prosperity. As history has shown, the September 1929 peak of the Dow Jones Industrial Average was followed by an almost 90% decline. It took the markets 25 years to recover to the level they were at before the catastrophe. What is typically missed is the fact that following the first drop, the industrial average of the Dow Jones was shown to recover by 48% between the middle of November and the middle of April of 1930. Nobody was aware that this event marked the beginning of the biggest economic downturn in the history of the United States, which resulted in an 80% loss in the Dow Jones and a market bottom that occurred within the year 1932. Everyone is nervous about the market right now, because it makes them think of what occurred in the past. Pay attention to what Cathie has to say. She will go over the 3 most important arguments in favor of this concept. First and foremost, most people in the economy, the consumers, are not eager to make large purchases. Cathie already stated this year that businesses have too much stock and must lower prices to move it. Even when customers are being offered significant price reductions, the problem still exists. If you want a deeper grasp of this concept, I highly recommend listening to the original clip in which Cathie explains it. Here it is.
The reason I think we're in a recession, and we've talked about this, we won't go into it too much, but the inventory buildup that Walmart and Target and Home Depot, Costco, all of them were describing in their April quarters. They do not seem to have gotten them under control if the macro indicators are any indication. We've got on both the wholesale and the retail level month-to-month increases in the 1.5% to 2% range. Now, if GDP is revised, and it could even be revised into positive territory because of inventories, that won't take us off of this recession, this thought that we're in a recession, because inventories are piling up because consumers are shutting down. And they'll have to clear the inventories with discounts.
Consequently, stores are flooded with stock despite a decrease in consumer confidence, according to a poll conducted by the University of Michigan's Consumer Sentiment Index. It begs the question, what the heck is going on in the world right now? The second of Cathie's points is an expansion of the first. The yield curve is often regarded as one of the most reliable leading indicators of future economic activity. As we have discussed numerous times before, a recession is anticipated when the curve falls to this level underneath the line. Taking into consideration the reversal of intensity that has occurred over the course of the past few weeks, we are able to obtain a serious signal about the forthcoming recession. If you listen to the clip from its original upload, you may observe how pessimistic Cathie has become in light of recent events in the bond markets.
On almost 70 basis points to 2.83%. Meanwhile, short-term interest rates, 2-year Treasury yields, they have moved up in lockstep. They're at 3.24. So now we have an inverted yield curve to the tune of 41 basis points. It's just getting more and more inverted. And that's basically the fixed income markets telling the Fed, okay, something's going to give here. It's going to be the economy, which is caving in many ways, or inflation, or both. And we think the answer is both. And we also think, and I'll get into this in a moment, that the surprises are going to be quite significant on the downside when it comes to inflation.
One last thing to consider is how the housing market has been mostly unchanged. The housing market accounts for between 15 and 18% of GDP. According to recent reports, sales and prices have decreased, which puts additional stress on the situation's already precarious condition. Cathie noted that Robert Shiller, the creator of the most widely used housing index known as the Case-Shiller Index, anticipated that home values will fall by 10 to 15%. In numerous interviews, Cathie has detailed the reasoning behind her investments. Their focus is on the long term. Therefore, they don't care about the short-term discomfort, and their investment thesis is often 5 years or more. With little concern for the immediate discomfort, she anticipates receiving a return worth 10 times as much. Check out this clip from Cathie upload.
If you look from the bottom of the coronavirus to that peak in
February of 21, we were up 358%. Why? Because innovation solves problems, right? Now we're down 60%, and we have a whole new set of problems, certainly coming out of Russia and Ukraine. If you look at our strategy over a 5-year period, look at the last 5 years, I'm not quite sure what the numbers are, but they are well above our minimum hurdle rate of return, which is 15% at a compound annual rate. And I think over 3 years, we're closer to 25%. So that helps put our performance into perspective. You know, this is a period, if you believe in innovation and that innovation does solve problems. We had a preview of that after the COVID crisis, when our strategies in the span of a month, many of the stocks were taken down 75% because either they were burning cash or they had low cash cushions. But guess what? Those were the genomics companies that were going to get us out of the coronavirus. And today, what do we have? We have all kinds of problems, the latest of which is Russia, Ukraine, and all of the commodities coming out of that area, especially hitting Europe. I think we're going to be looking at a lot of demand destruction and substitution into innovation. Electric vehicles as opposed to gas-powered vehicles would be the biggest one. We also have labor shortages all over the place. Again, automation. This is innovation at its best, and it's being turbocharged by this environment as the market is really hitting our stocks. So I think if you were to look at the next 5 years, and if you were to give us that 5-year investment time horizon, we are the closest you'll find to a venture capital fund in the public equity markets. If you were to give us that 5 years, given our expectations for growth in these new technologies, I think we're going to see some spectacular returns.
As a result of all of this, the majority of people have started to believe that the current scenario is simply the opening salvo in a series of knockout blows delivered by the market before the commencement of the true catastrophe. Knowing who to trust and who not to is becoming incredibly hard. There are numerous competing statistics that point to both optimistic and negative trends. In addition to all of this, recent events that have taken place in the Federal Reserve and Europe have the potential to alter the trajectory of the market as a whole with the use of a single careless phrase or an incorrectly positioned bomb, according to an article. The amount of risk that exists has increased, which has brought a temporary halt to the bull market that has lasted for a record-breaking 30 years. Nobody is certain of the future course of events, but if we take Cathie's advice to heart, we should treat this recent upswing with at least some skepticism. Do you think Cathie Wood is bound to profit from her investments? Or do you think she has placed her assets in the wrong place? What do you think are the best investments at this time? Give us your thoughts in the comment section down below. If you enjoyed this video, kindly like and subscribe. And we'll catch you on the next one.